Trump escalates trade threats targeting Apple and European Union imports. German economy grows more than expected in first quarter of 2025, revised up to 0.4%. And Syrian finance minister says measures underway to attract foreign investment post-sanctions.
Transporter.
Welcome to the Economic Bulletin. We start off with the U.S. Treasury Department, which has confirmed it will stop producing 1-cent coins or pennies next year. The decision, driven by President Donald Trump's call to end the wasteful practice, comes as the cost to mint a penny has risen to 3.69 cents. Phasing out the coin in circulation for over 2 centuries is expected to save $56 million annually and will require businesses to round prices. U.S. President Donald Trump dramatically escalated his trade threats on Friday, targeting both Apple and imports from the entire European Union. Trump threatened to impose a 25% tariff on Apple for any iPhones sold in the United States but not manufactured domestically. He explicitly stated on Truth Social that he expects iPhones sold in the U.S. to be built in the U.S., not in countries like India. Additionally, he announced a recommendation for a 50% tariff on the European Union to begin on June 1st, which would affect luxury items, pharmaceuticals, and other European goods. In response to Trump's threat, German Economy Minister Katharina Ricci stated that trade conflicts have no winners and called for the European Commission to reach a negotiated solution with the United States. Ricci asserted that tariffs are equally damaging to both the U.S. and the European Union, arguing that more trade is needed, not less. She confirmed that Germany is maintaining intensive contacts with the European Commission on the matter. Moreover, Poland's trade minister downplayed the immediate threat of President Donald Trump's proposed 50% tariffs on European goods set for June 1st. Despite Trump's assertion that trade talks were going nowhere, he emphasized that European Union and the United States negotiations are ongoing, with time available until early July. The tariff threat targeting European luxury items and pharmaceuticals had sent global markets dropping. Now we move on to the latest developments from the MENA region. Moving to Europe, the Statistics Office has reported that the German economy grew significantly more than expected in the first quarter of 2025, expanding by 0.4% from the previous quarter, a revision up from 0.2%. The stronger performance ends a period of contraction and outperformed the Eurozone average. The growth was primarily driven by exports and industry front-loading ahead of U.S. tariffs, alongside a robust household consumption. While some economists view this surge as potentially a one-off, others see reasons for continued optimism. The Office for National Statistics has reported that British retail sales volumes jumped a stronger than expected 1.2% month-on-month in April, boosted by sunny weather. This increase marks the fourth consecutive monthly rise in retail sales, a feat not seen since 2020 and the longest run of growth since 2004 outside of the pandemic. Food sales jumped significantly by 3.9% in April, which the Statistics Office linked to the sunniest April on record. Compared to April 2024, retail sales volumes were 5.0% higher, marking the biggest annual increase since early 2022. Despite recent strengths, overall retail sales remain 0.6% below their 2019 average. British consumer confidence saw a modest improvement in May, with market research from firm GfK's index rising to -20 from -23 in April, exceeding economists' forecasts. This uptick was driven by greater optimism among households regarding their finances and the broader economy. The rise may reflect the impact of recent interest rate cuts and an easing of global trade tensions, though overall confidence remains below the long-run average. The National Bureau of Statistics has reported that China's online retail sales rose 7.7% year-on-year in January to April, led by surging demand for smart devices and trade-in programs. Smart robot sales jumped 88%, while mobile phones trade-ins grew 19%, official data shows. The growth comes as China expands its Silk Road e-commerce initiative to 34 countries, with over 3,100 foreign firms joining Chinese platforms since April. Cross-border payments have been streamlined with ASEAN nations, boosting international trade. Japan's core inflation accelerated at its fastest annual pace in over 2 years in April, reaching 3.5%. This exceeded market forecasts and continued to stay above the Bank of Japan's 2% target for more than 3 years, primarily driven by steady increases in food costs, including a near doubling of rice prices. Despite the sticky prices, some analysts anticipate inflation to slow later in the year as the yen strengthens and tariff impacts might temper wage growth, a key factor for the BOJ's sustained inflation target. Official data has shown that Singapore's economy expanded faster than expected in the first quarter of 2025, growing by 3.9% year-on-year. This growth was boosted by stronger global demand and business front-loading activities to preempt higher U.S. tariffs. However, the government warned of persistent downside risks from a potential full-blown trade war between the United States and China. On a quarter-on-quarter basis, the economy actually contracted by 0.6%, signaling challenges ahead. The National Statistics Agency has reported that Mexico's headline inflation rose more than expected in the first half of May, hitting an annual rate of 4.22%. This marks the first time this year that inflation has jumped outside the central bank's target range of 3%, plus or minus 1 percentage point. Consumer prices increased by 0.09% in the first 15 days of May from the previous half-month period. The closely watched core price index, which excludes volatile food and energy prices, climbed 0.16% in early May, bringing annual core inflation to its highest level since August 2024. And for further analysis, we're joined by Meher Nicholas, Director of the EU Asian Center. Welcome, sir, to Qnews Economic Bulletin. And starting with Apple, what are the legal and practical limits of a U.S. president imposing tariffs on a single company like Apple?
I think it's so far. I mean, the issue is very complicated. Okay, so in U.S. law, you cannot just cherry pick one single company because you don't like the CEO and say I'm going to slap tariffs or sanctions or hit one company. So in U.S. law, you cannot do that. Now the problem is psychological, and in America, the federal government has a lot of power, directly or indirectly. So no company, large or small, wants to be at odds frontally and brutally with the White House. So I think, what happens is the Apple, Tim Cook, they played a game with Trump for the past 3 months. So literally 3.5 months ago, on his first week in the White House, Trump started that, tit for tat game with the CEO of Apple. It was never like that serious, but now that he has fixed, quote unquote, so Trump having come to some kind of understanding with Britain and China, so he ticked the box in a way when it comes to China, Britain, Mexico, Canada. Now he can focus more on the European Union and put pressure on the European Union, and he can focus more on one or two Silicon Valley companies which he thinks aren't behaving properly, like Apple. So the pressure now is more serious, and the reason why it's more serious is unlike the situation 5 weeks ago when Trump started his Liberation Day, global trade confrontation. Trump was fighting many battles simultaneously at the same time. And even if you are Trump, even if you are America, it's difficult to fight Mexico, Canada, and China, and Japan, and Europe, and Apple, and Nvidia simultaneously. That's what Trump did 5 weeks ago, and the first 2 weeks were not good for him. But he completely turned around the situation. So in the past 10 days, the White House has accumulated many victories. One of them was signing the trade agreement with Britain. The other one in Geneva 8 days ago was that macro general agreement with China. He also had an agreement kind of with Mexico and Canada. So it leaves him fewer targets to put pressure on. And I think that's why Apple is panicking, or the management of Apple is panicking. That's why the same day today, we saw many of the European stock exchanges go down, because now he's focusing more on them and more aggressively.
Yes, sir. Speaking of the pressure Trump is imposing and taking a closer look at his demands and the timing factor as well, how realistic is for Apple to fully shift iPhone production to the US or even India by 2026?
It's a tough question, because basically these state-of-the-art advanced factories, you cannot build them overnight, right? So it's a long commitment. It's akin to an infrastructure investment. So when you're investing in a big giant factory or an infrastructure asset like a bridge or an airport or a port, it takes you 3, 4, 5 years to do it. So it's not like you can move your factory in 2 weeks. So I think by putting pressure aggressively on the management of Apple, by saying you have to do it by December 31st, 20, whatever, 25 or 2026, he wants to reach a deal with them. Trump is a deal maker. And so he wants, want them to sit with him at the table and reach a compromise. So I think at the end of the day, after the management of Apple, Tim Cook and Trump meet for a few hours and have reached a deal, and the deal is a middle of the road solution. It's a compromise. So they will both have to compromise. Trump will have to compromise, and Apple too. And once they reach that middle of the road solution, in my opinion, they will build some factories, not all their factories, but they will commit in writing to build some factories in America, in California, Texas, Pennsylvania, etc. And in my opinion, it will be states which are, Rust Belt. So I think symbolically, Apple will be directed to invest in Oklahoma, Pennsylvania, Illinois, Rust Belt in Michigan. Once they commit to that, Trump will allow them to keep some factories in China and India. Once again, it's about reaching a middle-of-the-road solution.
Yes, sir. Now, moving on to the European Union and the re-escalation we've witnessed by Trump, how could a 50% tariff on European Union goods impact trade and industries like luxury and pharmaceuticals specifically?
It would be disastrous. So now, as opposed to 5 weeks ago, once again, when Trump started his Liberation Day or trade war, now the pressure is more serious, more aggressive, and more real. And so that's why we see many European policymakers and CEOs of big companies today panicking. Today in the afternoon, European time, which is the morning Washington time, panicking because that global power play. So what Trump is doing is part of a global universal power play. Trump already ticked the box with China. He's got a deal with China, kind of, roughly. He signed a trade deal with the UK, with Britain. Mexico and Canada, it's practically done. So now he can focus aggressively on Europe only, on the European Union only. And so now the threat of tariffs from Washington is no longer a theoretical threat. He's focusing on Europe, and Europe is alone because Europe will not be helped by China or Japan. So Europe is really alone, and it's happening at the wrong time for Europe because economic growth in Europe is collapsing regardless of Trump. So Germany, France, Italy, they have a GDP growth problem. Add to that the threat of tariffs. And of course, for countries like Italy or France or Germany, having 50 or 40% slapped on BMW, Mercedes, Louis Vuitton, Louis Vuitton, Moet Hennessy, the biggest French company, is now, French is no longer an industrial powerhouse in the classic sense, but they are experts, they're very strong in the field of luxury goods. And Louis Vuitton, Moet Hennessy is the biggest company in France. So if Trump goes to the very end and slaps a 40, 50% tax on them, it would be a disaster for the biggest French company. Likewise, Gucci, for example, in Italy, French and Italian winemakers, it would be disastrous.
Yes, sir. Building on your statement that the pressure is getting more serious, let's assess Trump's strategic motives here. Are these tariff threats primarily political leverage, or could they materialize into enforceable policy?
I think both. And if you want to put, and this is really the classics of corporate strategy, business strategy, and military strategy, right? So you want to keep all your hands. If you're fighting against someone, be he a rival, an enemy, or even a friend, if you have a rivalry with someone, you hold your cards near you, you don't show your cards, and you keep the enemy guessing. And I think that's why the Europeans today are panicking, because initially they did not take Trump seriously, which is very, very strange, because Trump has been warning them for more than 3 months. And even though repeatedly Trump has warned them, what's shocking is policymakers in Brussels, Berlin, Paris did not take him seriously for a simple reason. They are desperately clinging to the neoliberal free trade globalization agenda. They don't realize, or the Europeans don't want to understand, that in China and America, the two most important countries in the world, the two real superpowers left, they have moved past. They have moved past globalization and free trade. They are adopting a new model called neo-realism, and neo-realism is based, in essence, on economic nationalism, techno-industrial nationalism, linked to a certain degree of protectionism. It's not the end of trade, but it's the end of free trade. And the problem is in France, in Germany, in Italy, they want to believe desperately that neoliberalism and free trade and globalization are still here. They're no longer here, they're dying. And I think today, the reason why the stock exchange in Madrid, Milan, and Paris is going down is at last the Europeans are realizing that Trump is very serious about what he means. He means what he says.
Mm-hmm. Now, sir, I have to ask you, what message do these threats send to global markets and investors already wary of the U.S. physical instability?
So now, and this is why we should always compare what's happening today and next Monday when Asian and Australian stock exchanges open Monday morning. Right now is very different from 5 weeks ago. 5 weeks ago, Trump made a mistake. He wanted to fight the whole world at the same time. He wanted to fight simultaneously the Chinese and the Brits and the Mexicans and the Europeans. It didn't work. And he paid a price for that because for 2 weeks, markets collapsed, financial markets collapsed globally. And the most punished financial markets was Wall Street. So if you remember, 3-4 weeks ago, the NASDAQ and the S&P 500 and the Dow Jones indices were collapsing. People were selling the dollar and people were selling US government bonds. Trump learned the lesson. That's why now he's focusing only on Europe. So now the crisis will be more limited because in essence, he's only, quote unquote, putting pressure on Paris, Berlin, Brussels, Madrid, Milan. So yes, financial markets, they will not like it, of course, but the degree of downward pressure on financial markets should be more limited in principle. We'll see how things go, next week.
Mm-hmm. That was Meher Nicholas, Director of the EU Asian Center. Thank you so much, sir, for your insights and for all the information you provided us with here on the Economic Bulletin. Thank you. Now we move on to the latest developments from the MENA region. Reuters has reported that Russia is in advanced talks with Bahrain for a 3-year liquefied natural gas agreement under which Moscow would supply the Gulf Kingdom with 1.5 million metric tons of the fuel annually. This prospective deal, the first of its kind between the nations, would expand Russia's global energy market presence and intensify its liquefied natural gas competition with the United States. Russia, currently the world's fourth largest liquefied natural gas producer, aims to become a top 3 global exporter. Bahrain, host to the U.S. Navy's Fifth Fleet, seeks the imports to address summer gas shortages. The agreement is expected to be finalized soon. Syrian finance minister has stated that his country is rolling out various measures to attract foreign investment following the US and European Union's announcement that economic sanctions would be lifted on the country. Speaking at the Islamic Development Bank meeting, he noted significant investor interest, particularly in urgent areas like energy and infrastructure, but also across other sectors, including agriculture and tourism. Emphasized Syria's commitment to creating the right environment with new regulations and infrastructure to welcome global investors.
Energy, there is a great appetite. We have seen to invest in Syria. There are great opportunity in all sectors: energy, agriculture, infrastructure, housing, tourism, healthcare, education, almost all sectors. Syria is rich of opportunities now. Of course, the lifting the sanctions created a sort of optimism, and that is a precondition for attracting investment. What we are trying to do now is trying to transfer this optimism into reality by creating the right infrastructure, the right regulation, and the right ecosystem that welcome investors.
In markets, stocks declined Friday after President Donald Trump raised trade fears again, warning Apple and recommending stiffer duties on the European Union. In the U.S., S&P 500 futures declined 0.69%, and futures tied to the Dow Jones Industrial Average both dropped 0.54%, and Nasdaq 100 futures decreased 0.94%. In Europe, UK's FTSE 100 dipped 0.31%. Germany's DAX lost 1.49%, and France's CAC 40 also lessened 1.77%. In Asia, Shanghai Composite Index decreased 0.94%, while the Hang Seng in Hong Kong was up 0.24%, and Japan's Nikkei 225 rose 0.47%. That brings us to the end of our economic bulletin. Here's what we've been covering. Trump escalates trade threats targeting Apple and European Union imports. German economy grows more than expected in first quarter of 2025, revised up to 0.4%. And Syrian finance minister says measures underway to attract foreign investment post-sanctions. This concludes our economic bulletin. Don't forget to follow Q News on YouTube, Facebook, X, Instagram, and TikTok at Q News EG to stay informed. Thank you for watching and stay tuned for more updates on Q News.